Strategy, formerly known as MicroStrategy, just bounced nearly 30%. But at the same time, several institutional investors were heading for the exit. That's the tension around the company's stock right now. Several mid-sized investors reduced or completely exited their exposure to Strategy. Angelus Wealth Management and Wealth Watch Advisors both cut their holdings by 100%. They fully exited the stock. Caitlin John LLC reduced its position by more than 96%. Across multiple firms, we're seeing either full exits or substantial reductions in the previous quarter. These reductions are being revealed just as the stock is attempting a recovery. That naturally raises a question. How strong is institutional conviction behind this rebound? Strategy, formerly known as MicroStrategy, just bounced nearly 30%. But at the same time, several institutional investors were heading for the exit. That's the tension around the company's stock right now. On the surface, it looks like it's trying to stabilize. Strategy's ticker is trading around $135 after rebounding from its February 5th low. But step back, and the bigger picture is still heavy. The stock is down about 19% over the past month and more than 60% over the past 3 months. This isn't a clean turnaround. It's a sharp bounce inside a much larger downtrend. Then came the latest disclosures. On February 23rd, new 13F filings were released. These are quarterly reports that large investment managers must submit to the SEC, listing the stocks they held at the end of the previous quarter. Though they don't show real-time moves, they do reveal how institutions were positioned during the last stretch of weakness. And when you scan the filings, a clear theme emerges. Several mid-sized investors reduced or completely exited their exposure to Strategy. Angelus Wealth Management and Wealth Watch Advisors both cut their holdings by 100%. They fully exited the stock. Caitlin John LLC reduced its position by more than 96%, effectively stepping aside. Other firms didn't go all the way to zero, but they made meaningful cuts. COVID's investment group trimmed its position by about 19%. And the value of what it held dropped by more than 60% as the stock declined. Atomy Financial Group reduced exposure by roughly 18%, with a similar collapse in the value of its position. Across multiple firms, we're seeing either full exits or substantial reductions in the previous quarter. Even the more supportive-looking moves need context. Invesco increased its share count by around 14%. But the value of that position still fell by more than 46% because of the broader price drop. Now, it's important to stress, these filings are backward-looking. They reflect how institutions were positioned at the end of the last quarter, not necessarily what they're doing this week. But markets respond when this information becomes public, and the timing is significant. These reductions are being revealed just as the stock is attempting a recovery. That naturally raises a question. How strong is institutional conviction behind this rebound? What makes this more nuanced is that just 1 week earlier, on February 16th, the picture looked somewhat different. At that time, the Chaikin Money Flow Indicator, which tracks whether large money is flowing into or out of a stock, was showing steady accumulation. In simple terms, it suggested that bigger players had been buying even while the stock was drifting lower. At the same time, on-balance volume, a metric that tracks cumulative buying and selling activity, was trending lower. That indicated smaller investors were gradually stepping back. So the earlier data showed a split. Institutions appeared to be absorbing shares, while retail investors were losing confidence. Now, with the 13F filings out, it looks like at least some of that institutional support may have been weaker than initially thought. That shift increases uncertainty, especially for a company that is tightly linked to Bitcoin. Why? Because Strategy no longer trades like a traditional software business. It trades like a leveraged Bitcoin vehicle. The 7-day rolling correlation between Strategy stock and Bitcoin recently surged to 0.98. A correlation that high means the two are moving almost in lockstep. When Bitcoin rises, it just tends to rise. When Bitcoin falls, Strategy often falls harder. The reason is straightforward. Strategy now holds more than 717,000 Bitcoin, Its entire corporate playbook is built around accumulating Bitcoin and using capital markets to expand that position. When Bitcoin rallies, the stock often amplifies those gains. But when Bitcoin declines, the downside can also be amplified. As of mid-February, Bitcoin was trading near $67,400. That's well below Strategy's average purchase price of about $76,000 per coin. On paper, that translates into roughly $6.1 billion in unrealized losses. At the same time, the stock has been trading below the value of the Bitcoin it holds on a per-share basis. This is measured by MNAV, or multiple to net asset value, which compares the stock price to the value of its Bitcoin per share. Right now, that ratio is below 1. In simple terms, the market is valuing Strategy at a discount to its underlying Bitcoin holdings. That discount matters because the company relies heavily on selling new shares to raise cash for more Bitcoin purchases. When MNAV is above 1, issuing shares can work in shareholders' favor. But when it's below 1, the company would be raising money at a price that's lower than the value of the Bitcoin it already owns, which can dilute existing investors and weaken the benefit of future purchases. That backdrop helps explain the announcement on February 12th. Strategy CEO Phong Le said the company plans to rely more on a different fundraising tool called Perpetual Preferred Shares, branded Stretch. This is what he said in a recent interview.
Look, Bitcoin is digital capital. And as digital capital, it's a non-sovereign, decentralized store of value asset that's supply limited, and it's digitally engineered to do so. And it sees up and down volatility because of its digital characteristics. When Bitcoin goes up, you'll see DATs go up more. That's how Strategy is engineered to be amplified Bitcoin. And as Bitcoin goes through a bear market, Strategy goes down more. I think the interesting story is we've engineered something to protect investors who want access to digital capital without that volatility, and that's Stretch.
Here's what that means in practical terms. Instead of raising money mainly by selling more regular shares, which fluctuate heavily with the stock price, the company wants to issue a different type of investment that pays a regular dividend and is designed to trade around a more stable price. The pitch is simple. Investors who want exposure to Strategy's Bitcoin-focused model, but with less to day-to-day volatility, can buy these preferred shares instead. But so far, this has been a small part of the capital mix. Recently, the company raised roughly $370 million by selling regular shares and only about $7 million through preferred shares to fund Bitcoin purchases. Management has said they expect preferred capital to become a larger part of the equation over time. For common shareholders, this isn't purely good or purely bad. It introduces trade-offs. On one side, relying less on selling regular shares could reduce direct dilution when the stock is trading below the value of its Bitcoin. That may help protect Bitcoin per share in weak market conditions. On the other side, preferred shares typically come with promised dividend payments. That means the company commits to paying investors regularly, regardless of where Bitcoin trades. If Bitcoin stays weak or falls further, those payments obligations remain. They don't adjust with the market. So while this shift changes how the company raises money, it does not remove the core exposure. Strategy is still fundamentally tied to Bitcoin's price. The financing structure may evolve, but the underlying volatility remains. Now, let's look at what the market is signaling beyond the headlines. Despite the recent 30% rebound, the broader price trend remains fragile. The stock has struggled to reclaim prior highs, even as short-term momentum indicators briefly improved. In plain terms, it bounced hard, but it hasn't convincingly broken the larger downtrend. We saw a similar setup between December and February. After that pattern formed, the stock fell nearly 14%. Volume trends reinforced the caution. Since November, trading activity has leaned more towards selling than steady accumulation. In other words, there's been more consistent distribution than strong buying interest. Even during this recent rebound, the volume behind the move hasn't been particularly convincing. When a stock rises but the buying activity doesn't meaningfully increase with it, it can signal weak conviction and suggest that the rebound may not have strong support underneath it. At the same time, other measures have shown that some investors have been stepping in to buy dips over the past few weeks. That likely explains why the stock has managed to hold above its February lows and even post modest gains over the past several days. But selective dip buying is not the same as broad institutional accumulation. Without sustained participation from larger investors, rebounds can lose steam quickly. So what truly matters from here is not every short-term price level. The bigger issue is directional pressure. Strategy is facing resistance overhead while volume remains uneven and institutional positioning has become more uncertain. If Bitcoin stabilizes and begins to recover, strategy could extend its rebound. But because strategy moves so closely with Bitcoin, if Bitcoin weakens further, it's difficult to see the stock holding up on its own. That's the central risk. Strategy is not just exposed to Bitcoin. It is structurally dependent on it. Its balance sheet, its fundraising approach, and its stock performance are all intertwined with Bitcoin. The recent rebound shows how quickly sentiment can flip. But with institutional exits surfacing, billions in unrealized losses on its Bitcoin holdings, a discount to underlying asset value, and a shift in financing underway, the recovery is being tested at a critical moment. The next major move in Bitcoin could very well determine whether this rebound turns into something more durable or whether it ends up being another temporary relief rally inside a broader downtrend.